morning, all. Can you believe it's August already? Hopefully, the worst of winter is over and we can look forward to summer just around the corner. It's a good time now to take stock of the first half of 2021. While most of us expected a rebound in growth as economies started opening up, the rebound on the upside has caught a lot of us by surprise. This is all on the back of the development of a vaccine and the rapid rollout of the vaccine in developed economies. However, the vaccination numbers in emerging markets, including that in SA, are lagging, and the Delta variant could possibly dampen growth for the second half of 2021. Locally, our GDP has rebounded off a low base, but unfortunately has not been broad-based. Mining and agriculture have recovered, but tourism and leisure are still in recession. And if we don't reach herd immunity in the next couple of months, tourism and leisure will continue to be impacted. During the second quarter of this year, the progress in vaccine rollouts worldwide, positive corporate earnings, and positive economic news continued to lift developed equity markets, even as concerns emerged over high valuations. On the local front, the Aussie was roughly flat for the second quarter. The standout index was listed property, where the SAPI posted a total return of 11%. In this environment, our portfolios had another good quarter, with all our factor portfolios recording positive returns. The allocation to fixed interest and property were the primary drivers of return, while the other asset classes also contributed to the positive returns. During the quarter, we reduced local equity marginally and parked the proceeds in cash just to have some dry powder in the portfolio ready to be redeployed in the event of market weakness. While we are very pleased with the strong recovery in equity markets since March last year, COVID has, however, distorted the base as the 3-year, 5-year, and 7-year local equity returns are still in single-digit territory, evidence of the low return environment, and hence achieving real returns in either high or low equity funds has been a challenge. However, I am pleased to report that our factor range of portfolios have managed to outperform their respective strategic asset allocation benchmarks over most periods. Given the strong recovery in markets over the past 15 months, the risk of short-term setbacks and increased volatility are rising. We maintain the view that risky asset classes should continue to benefit from the recovery in global growth, as long as the current supportive monetary and fiscal policy settings remain in place. Close attention will be paid to signals from the central banks in terms of rising rates and the tapering of monetary support. We maintain a healthy exposure to domestic and offshore equities, but as always, remain well diversified from an asset class, strategy, and fund manager perspective. While we are all learning to cope and live with COVID, we at Momentum Investments are confident that our portfolios are well positioned and suitably diversified across asset classes and strategies, and we will continue to manage the portfolios in a prudent manner. Thank you for your time and look forward to catching up with you again soon. And please do stay safe.